Hi, welcome. Brett Dunn here with the DayBreak Group. I'm here with Mr. Young of Advantage Tax Services, and I got a question to ask you today.
Sure.
There's a new federal rule that just came around concerning the mortgage deductibility of interest. What is that?
Exactly, Brett. What occurred was under the Tax Cuts and Jobs Act of 2017, we now have a new rule about the deductibility of home mortgage interest on new purchases. So if you already owned your home, none of this applies. The old rule was that you could borrow up to $1 million of primary acquisition debt, and the interest on it could be written off, along with $100,000 of borrowed home equity interest. The home equity interest is no longer deductible at all, and the limit now on a purchase is $750,000 of borrowed money for the deductibility of the interest. You can of course buy more, and you can also borrow more, but you're going to be limited on that $750,000 amount to calculate toward deductible mortgage interest.
Well, my property tax is $20,000 a month, hypothetically. What happens then?
Well, that rule has been changed as well. There's a deduction from our past called the SALT, state and local taxation. Previously, it was an unlimited amount of deduction. And of course, people in real estate ownership in California had large amounts of real estate taxes, which was part of that SALT deduction. The combined is now limited to 10 grand between the real estate taxes and your other state and local taxes. So it's a cap overall on the deductibility of that one. So for many people with large, expensive homes who have high real estate taxes, they're going to be hit with that limit in California, unfortunately, under the new tax laws.
Not so great.
Not so great.
Now, just so if I understood you correctly, I've got a HELOC on my home right now that I've had for a couple years. How does this affect me with my HELOC?
Well, HELOCs from the past are going to be okay as long as the proceeds were used to purchase or acquire or upgrade your home. So you're still going to be good there. If it's money that was borrowed for trailers and other things that aren't related to the home, pay off of student loans or whatever you did with it, that's no longer deductible.
Excellent.
But if you use it to acquire, upgrade, or build new homes with, it's still deductible, but the whole thing still fits within that $750,000 range now. Previously, you had the million and an additional 100, so you could technically write off the interest on $1,100,000. Now it's still limited to 750. Home equity can still come in there, but it has to be only for acquisition type debt. Previously, that was not the case.
Wow, great information. And if you have some other questions that you want me to ask, please email them in to me, text them in to me, and we'll make sure that Mr. Young gets back to us and answers them. Thank you very, very much. Thank you, sir. Very appreciate it.
You bet.